Thanks for clicking. The Bank of Canada will probably announce on Wednesday that it's going to be keeping interest rates higher for longer, according to a research note coming from Capital Economics. The research says that the Bank of Canada could strike a hawkish tone at Wednesday's announcement, engaging in a new round of forward guidance and declaring that interest rates will have to stay higher for a longer period. The new forward guidance would be very similar to when the Bank of Canada offered its forward guidance during the pandemic, when it promised that it would be keeping interest rates low well into 2023.
And he wouldn't lie, would he?
The message from Capital Economics comes as a number of banks, economists, and institutions are weighing in as to what the Bank of Canada will be doing in 2023, with most agreeing that Wednesday's announcement will consist of a 25 basis point rate hike, and after which we'll see a pause. But the report from Capital Economics says that although we might see a pause coming from the bank at Wednesday's announcement, we will also probably see some form of forward guidance. So what I want to do today is go over some of the predictions being made by Capital Economics in its new report, discuss some of the implications of a new round of forward guidance coming from the Bank of Canada, and then go over what to look for next. The bank will be making its much anticipated interest rate announcement on Wednesday the 25th, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. As mentioned, Stephen Brown from Capital Economics said that at Wednesday's announcement, the Bank of Canada will likely indicate that rates are going to be staying higher for longer. Brown said that the Bank of Canada is likely to engage in another round of forward guidance, assuring the markets, assuring Canadians that rates will be higher for longer, higher for 2023, and maybe even into 2024. Forward guidance is a tool used by the central banks when they don't want to use traditional methods, raising interest rates higher or lower. Forward guidance was used during the pandemic when interest rates were already close to zero, at their effective lower bound, as a means to stimulate the economy without actually having to move into negative interest rate territory. Indeed, if you tell Canadians that not only are interest rates low right now, but will remain so for the foreseeable future, they are more likely to spend, they are more likely to borrow and spend, which will in turn stimulate the economy. So you've got that economic stimulus without actually having to lower rates.
I got you! You should have seen your face! You should have seen your face!
And yeah, the idea this time around would be to offer similar forward guidance, assuring Canadians that rates are going to remain higher for longer, letting Canadians know that it's not going to be getting any better time soon, in the hope that they slow down the spending. In offering this forward guidance, the bank's hope would be that Canadians would slow down the spending without the bank actually having to raise rates, without the bank actually having to have an impact on holders of variable rate mortgages, on holders of variable rate lines of credit. So the bank would be able to achieve that policy response, the slowing down of the economy, without actually having to increase interest rates.
Fool me once, strike one.
Yeah, that's a decent point. There's all kinds of evidence out there that very few are trusting the narratives coming out of our central banks. The Federal Reserve has said that it's going to be raising rates into 2023 and not to expect any cuts for the foreseeable future. Yet, the markets continue to predict a cut when the economy inevitably goes south. And it's not just in the US. North of the border in December, Tiff Macklem warned that the bank would rather raise rates too much than not enough. And yet we've seen our bond yields drop. We've seen them drop over 100 basis points since they've reached their peak in October. And it's not just the markets that are predicting a reverse on the Bank of Canada either. TD and National Bank are both expecting rate cuts by the end of 2023, with even Capital Economics expecting the bank to cut rates in September, once the economy goes south. So while the Bank of Canada might try to engage in some type of forward guidance, letting Canadians know that rates are going to be high for the foreseeable future, it's not clear that the trust is there, with even TD Bank, as of recent, blaming the Bank of Canada for the current problems facing holders of variable rate mortgages. With that said, as a brief aside, even though TD is blaming the Bank of Canada for the major problems facing holders of variable rate mortgages, I do have to believe that the higher-ups very much knew during the pandemic that a major increase in the money supply combined with a major decrease in production vis-a-vis supply chains, lockdowns, etc., I have to believe that they very much knew this would result in inflation.
Why didn't you tell the rest of us?
I have to believe that the Bank of Canada knew that as well, but that's a discussion for another time. Regardless, while the Bank of Canada might engage in some form of forward guidance on Wednesday, telling Canadians that rates are going to be high, so to slow down the spending, it's not clear that A, the markets are going to believe them, or B, that everyday Canadians are going to believe them either, with a lot of Canadians feeling more than a little bit burned by the forward guidance that we had during the pandemic.
It fooled me, we can't get fooled again.
In fact, as far as trust of the Bank of Canada goes, according to the July release of the Canadian Survey of Consumer Expectations, the last time that this data was released by the Bank of Canada, trust in the Bank of Canada to do its job to reduce inflation has dropped considerably since 2019. Forward guidance very much did its job in 2020 and 2021. In addition to the lower interest rates, Canadians spent and Canadians borrowed. Canadians spent and borrowed a lot, which very much propped up the economy during those pandemic years. However, when the Bank of Canada failed to reverse course on forward guidance, failed to respond to a change in the data, to increasing inflation rates, I think there was a lot of trust lost on the part of Canadians with our central bank. And when the Bank of Canada now wants to use forward guidance again, it's not clear that that the markets are going to be responsive. It's not clear that that trust has returned. With that said, we'll have a better idea of what the Bank of Canada is going to do at the rate announcement on Wednesday, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.